Welcome to MBA 507. I have a little article here that I'd like to read to you folks on bonds, inflation, and the effect of interest rate changes on the valuation of bonds. Let me get some more lighting on, though. It looks like I'm in a cave. Okay, that's a little bit better. I can see. And I'm sorry about the timing of this. Would be better off a couple weeks ago, but I just got this magazine this past week from Bloomberg Business Week. Every now and then they send me a supplemental called Quick Take. Hard to explain topics, explained simply. It's just what I need. Okay, the article is Bonds Big Fall. So that'd be the big fall in the price of the value of the bonds by Greg Ritchie and Libby Cherry. It doesn't say anything about their qualifications. And under the subtitle, it says, the bond market in the U.S. and other rich countries has long been boringly predictable, with prices by and large going steadily up and volatility far milder than in the more talked about stock market, and bonds being the more conservative investment. They don't, the risk return fundamental is true, and stocks are riskier. Bigger chance for a bigger payoff, also bigger chance for to lose your investment or the value to go down. Bonds are, like I said, more conservative. They fixed income. They are more directed. They say for older people like yours truly, but I don't believe I have any investment in bonds, government or corporate. Just don't care for them. The thing to remember is that they go inverse of the interest rates, and the Federal Reserve is hiking interest rates to try and rein in the effects of inflation. So that's going to depress the value of the bonds. Again, the bond has a stated rate of interest on it, fixed rate. That's what it's going to pay. And the price of the bond goes up or down in the market to equalize the rate of interest on the bonds with the market rate of interest. So if the interest goes up, the value of the bonds has to go down to counteract that. Okay, the inflation that's set in economics, in the economy let me start that over. The inflation that set in as economies rebounded from their pandemic collapse changed all that, leading global bond prices to fall by the most in at least 3 decades. The rout is forcing a rethink of frameworks that have long governed investment in the $100 trillion field. Okay, they have a 1, 2, 3, 4, 5, 6 bullet points here. It's a short article. It should be 10 minutes or less, 12 minutes. Why is inflation so bad for bonds? For 2 reasons. A bond is a contract laying out a series of fixed payments over time. The right to collect those payments is less valuable if inflation is expected to erode their purchasing power, the time value of money, one of our other 5 fundamentals of finance. The other reason has to do with the traditional central bank response to inflation, raising interest rates, a step meant to slow down economic activity by making borrowing more expensive. An increase in interest rates has a side effect of reducing the resale value of existing bonds. So that would be in the secondary market. That's because when bonds with an interest rate of 3% start landing on the market, traders will pay less for bonds paying 2%. Prices can begin to fall even at the first hint that a central bank might be considering a hike considering a hike. Again, so much is predicated in the economy is predicated on anticipation, the efficient market theory, how fast, how quickly we react to new information. That's one of the reasons gas prices skyrocketed in the last year and a half. What we're thinking the future holds. Again, the future is uncertain. So if we think it's going up because of certain geopolitical events or policies by certain governments, then people will start raising prices so that because they know it's going to cost them more in the future to drill it out, refine it, and deliver it. Second bullet point, what's been happening? Bond prices hit a peak at the start of 2021, then started to slide when inflation began to surge. That fall accelerated as it became clear later in the year that price increases were not transitory. Janet Yellen has admitted that when she made that statement, it was erroneous on her part. It was not transitory, as the U.S. Federal Reserve at first predicted. Again, she was a former chair of the Federal Reserve. She's now, I believe, the Secretary of the Treasury. Then in early 2022, a number of factors ratcheted inflation fears up even further. Again, fear of the future, the unknown, risk, including Russia's invasion of Ukraine, the sanctions imposed by the U.S. and European Union in response, and a new round of pandemic shutdowns in China. The rest of the world too, with the new variants. In March, the Fed launched what officials said would be a series of significant interest rate hikes. By June 14th, the Bloomberg Global Aggregate Index, a measure of total returns on corporate and government bonds, had fallen 19.7% from their peak. So if you had $100,000 worth of bonds, they're now worth $80,300. All right. Bullet point number 3. How big a deal is that? While it might not sound like much in the more volatile stock market, it was the largest so-called drawdown in bond market records going back to 1990. By one estimate, 2022 looks like the worst year for U.S. bonds since 1842. When the nation was mired in an economic and financial crisis, interest rates had been on a downward trend from the early 1980s. When the Fed conquered double-digit inflation, meaning that bond prices had been in a seemingly endless bull market since then. 40, 50-year market, I'd say is very bullish. That rally that has been supercharged more recently by the massive central bank's response in 2020 to the pandemic's economic toll when the Fed cut rates to near zero. Okay. Bullet point 4. Is inflation the only issue? Reply, no. As the world's biggest central banks either begin or prepared to fight inflation by pulling back on economic stimulus, worries rose that efforts would tip some countries into recession. Investors in bonds, just to mention the word recession, puts investors in a panic. Investors in bonds have a somewhat different view of downturns than most people. On one hand, hard times lead to more defaults, which are bad for lenders. On the other, interest rates typically fall in recessions, meaning bond prices often rebound. And in fact, the price slide stopped in May as bond investors held their fingers to the conflicting winds. Again, uncertainty, risk. Bullet point 5. Where did that leave investors? Reply, in an unusually tricky spot. Yeah, no kidding. In many portfolios, bonds are valued for steady income streams, for their lack of volatility, and because they can usually be counted on to move in the opposite direction to the stock market. Yes, when interest rates go up, the value of bonds go down. When interest rates go down, bond values go up. Again, bonds are looked at as a more conservative approach, and we could see that on that one exhibit in chapter 6, I believe, that showed the different types of investments over the last so many 80 years, 90 years, and what their returns have been averaged over that time period. They're less volatile than stocks. Of course, stocks are off 6,000 over 31, 16 to 20%. So bonds are down 19.7. Stock market's down somewhere between 16 to 20%, just in the top of my head. These last two features haven't held up recently. An investor who had a 60-40 split portfolio, the classic risk-adverse strategy, named after its share of equities and high-grade debt, 60% in stock, 40% in bonds, saw its value tumble by a fifth this year, 20%, as of mid-June. In the short term, traders were having to decide if the low prices were tempting. Again, low price is when you buy. But the thing is it going to go lower? Let's see. Attempting itself a bet on whether inflation was likely to peak soon. Others, I saw some numbers yesterday or today. The 9.1% for June. So even though they pulled out gasoline and petroleum products from the computation of inflation, it still increased over the 8.8 or whatever it was in May. So again, a lot of people, maybe you guys didn't notice that. And again, the news coverage, maybe didn't think it was relevant. I don't know where I saw it, but I picked up on it right away. And I saw through it that what it was an attempt by the administration to get the number, the inflation rate down, again, just playing on investors' anticipation of the future. If the number goes higher, it's bad news. If the number's lower, it's good news, and the market will start to recover. So they said, well, what can we do? Well, we'll recompute we'll change the way we compute an inflation rate, and we'll take gasoline out of it. But it didn't work yet. Maybe it will. Let's see. Others were still recommending that investors reduce their bond holdings, expecting that inflation would remain at historical high levels, even if a peak was reached. In that case, long-term yields could have further to climb as investors demand greater compensation for lending over a longer period, with inflation eating into their returns. Time value of money. Again, a lot of the 5 principles, and this is a short one-page article, are at play here. And the reason I'm doing time to read this out is to show you that what's in the book is not just theory, and it has applications in the real world. Finally, I guess the 6th bullet point, 6. What does it mean for borrowers? Rising interest rates will likely take a toll on economic growth. Yeah, financing is going to become more expensive. There'll be less money to invest in assets to produce things, in payroll, in advertising. You have a fixed budget. Well, hopefully at the end of the course, we'll get into capital budgeting and working capital management a little bit. And if interest rates go up, that's one of your fixed costs. If you've got loans, there's only X number of dollars you have to spend. And if you have to spend more paying the people you're borrowing money from, whether it be a bank or through corporate bonds, issuance of bonds, that's less money for other, investing in a new plant, expanding a plant, buying inventories, whatever. That's, there's only so much money. Where are we here? What does it mean for borrowers? Rising interest rates will likely take a toll on economic growth. In the U.S., the effect is more costly mortgages could be seen in the month after the Fed's first hike, as sales of new single-family homes fell to their lowest level since pandemic lockdowns began in 2020. People don't buy homes. People don't buy home repair improvement stuff at Lowe's or Home Depot to raise debt. As the days of easy money supplied by central banks come to an end, the creditworthiness of borrowers return to its normal prominence in the bond market. Okay, so again, just give you a little bit of a flavor that what we're talking about in the book and throughout the course will be is at work in the markets as we speak, as we breathe. All right, so 15 minutes went a little long because I added a couple of things along the way. Hope you enjoyed it. Hope you got something out of it. Thank you.